Hey guys, welcome back. In today's video, I want to answer a common question that I still see getting asked out there on social media regarding AMC's quarterly interest expense. If the debt is going down, how did the interest expense go up $20 million? And is that something that we should expect to see on an ongoing basis? And in this video, I'm not just going to give you a trite opinion and tell you don't worry about it, it's going to go down, it was one-time expenses. No, it is going to be here to stay, and I'm going to give you all of the DD that you need to understand why that happened. If that is of interest to you, or if you have questions about this sort of thing, stick around. Let's get right into it. Before we get into the detailed answer to the question on the screen here, I want to answer another common question. Why are you still talking about AMC? It's trash. I don't know about you guys, but the folks in my Discord made a lot of money trading AMC in 2024, and many or most of them completely fixed any previous losses that they had in the play. It is a high volatility play, and if you get a low entry and are willing to sell into run-ups, it's very easy to make money. And if you're running the wheel strategy, selling covered calls on your position, if you're holding a position, that is another way you can generate income off the stock. So I don't want to hear any of this nonsense about why are you still talking about AMC. It is a perfectly viable stock to trade if you like speculative plays that have volatility. But you must be smart about your entries. You must be willing to take exits. And more importantly, you must pay attention to the box office, the company communications, cash burn, and the cash on the balance sheet. I'm not in the play right now at all in any fashion. I'm waiting for some of the short-term risks that I'm watching to be resolved, and then I will likely start trading it again because I like speculative trading and I know how to manage my risk. In addition to all that, there are still, despite whatever you think, you might not like AMC, there are still people in the stock, and when I see misinformation or questions related to things like the interest expense, I think that it is worth giving people the correct information. So let's dive into the topic at hand here. Why is the interest expense 20 million higher? And will this be an ongoing thing going forward? Keep in mind, as you're watching this video, I'm not a CPA, but I did take accounting and finance in college, and I'm trying to present you a sort of overly simplified explanation of why the interest expense is higher. And if you are a CPA or a finance professional and you see anything materially, drastically incorrect here, feel free to drop something in the comments or send me a DM on Twitter and we can address that. But I think that having numbers here for you guys to look at will help you understand what is going on here and maybe hopefully clear up a lot of the misinformation that is continually still here in January 2025 being spread about the interest expense and the new debt deal that AMC enacted in July of 2024. Overall, over the last several years, AMC has reduced their debt by $1.5 billion. It's sitting just around $4 billion at the moment. But the July 2024 debt restructuring was not a debt reduction, it was a debt restructuring, and some of the pieces in the puzzle were moved around. If you want the simple explanation and you don't want to watch this entire video, the answer to why the interest expense is higher and going to remain higher is that the new debt deal has a higher interest rate. As you can see on the top line here, under the old debt deal, it was $1.89 billion term loan at 8.4% interest. AMC's credit rating is not as good, and with the new debt restructuring, they got a higher interest rate. And with the debt restructuring under that new term loan, we got $2.019 billion at 11.919% interest. That is a higher interest rate. And I think it's very simple for all of you to understand that when you have a higher amount at a higher interest rate, you're going to have a higher interest expense. It does get a little more complex. So if you're still with me and you want to dive into some more of the details, let's talk about that debt restructuring because it was comprised of two main components. The first lien term loan, which was just there on the previous slide, And the second part of the debt restructuring was the subordinate debt, the PIK toggle. It used to be a 10%, 12% PIK toggle. Now it is a 6, 8% PIK toggle. I always encourage you guys to read the financial statements, so I want to give you the source info if you want to look this up for yourself. The most recent 10Q from Q3 on page 16 has the entire debt table, and highlighted in green here at the top is the new term loan, 11.9%, $2.01 billion, and highlighted on about the fourth line in yellow is zeroed out because it no longer exists, that old 2026 term loan at 8.47%. Very simply, again, if you just want to know the basic answer and don't want to get into the more complicated accounting stuff, here is why the interest expense is higher. You do the math on these numbers. The old term loan quarterly expense for the term loan was about $40 million per quarter. And with the new debt deal and the higher interest rate, it is now around $60 million per quarter for that term loan. Remember, there are many components of the total debt package, everything on this table, but this is the main driver of why the interest expense is higher. That term loan is an adjustable rate. It's based off of the term SOFR plus 600 to 700 basis points. And that interest rate is locked in 2 days prior to the beginning of a quarter. And as rates have been coming down, I'm not expecting a big change for the interest expense in Q4, although we might see a reduction on the interest expense in Q1 due to those declining rates that you see here on the right side of this table. If I recall correctly, I think that the CEO told investors that due to that adjustable rate, for every 25 basis point reduction in the interest rates, the company would save $5 million annually in interest expense. And this table is just confirming that, yes, that is true. You can see on the first line here, if the rates went down a quarter point, that pink number on the far right-hand side would be a $5 million annual savings. If rates dropped an entire 1% with the adjustable rate on that first lien debt, it would be a $20 million savings per year, or $5 million per quarter. If you're still here for the more complicated part of the discussion, let's get into the other component of the debt restructuring, which was the PIK toggle. Now, a couple quarters ago, we had $777 million of 10-12 PIK toggle. That's 10% interest on $770 million, $19 million in interest expense per quarter. Under the new debt deal, the PIK toggle is now $414 million at 6%. And yes, this is that convertible debt. And I provided a video for you guys about why the debt is not going to convert at $5.66, despite what people keep telling you. It's not going to convert at $5.66. I'll put a video link up here above if you want to watch that video and get a little more informed on that to counter all of the misinformation that's going on. But with that new $414 million at 6%, that is only $6 million of interest expense for this component of the new debt deal. So that is about a $13 million reduction right there. All right. If it was 20 million more on the term loan and it's 13 million less on this, why are we seeing a $20 million interest expense increase on the income statement? For the answer to that, we need to dive into a little bit more complicated accounting stuff. When we look at the old term loan and the old PIK toggle and the new term loan and the new PIK toggle, AMC's actual cash outlay for the new debt deal is only about $7 million more interest expense. But then why on the income statement are we seeing a difference of $20 million? The answer to that question is an accounting term called net premium or discount amortization, and understanding how that non-cash amortization affects the income statement. On the bottom of page 16 in the latest 10Q, AMC even gives you a table letting you know what the net premium or discount amounts are that apply to those corporate borrowings. If I could explain this to you in layman terms, I would say that if the debt is issued at a premium, it is effectively a reduction on the quarterly interest expense. And if the debt is issued at a discount, like the bottom of the table here, the new debt deal was issued at a discount, it actually increases the interest expense reported on the income statement. Since the old debt was issued at a premium and the new debt was issued at a discount, when we factor in that amortization, the quarterly interest expense almost is exactly the same. $15 million on that old debt and $12 million quarterly expense reported on the income statement for the new debt. An easier way to say that is disclosed to you from AMC on page 21 of the latest 10Q, where they let you know that since those convertible notes were issued at a discount, when they are reported on the income statement, the portion of interest expense relative to these convertible notes is going to be reported at an effective rate of 13.42%. They're still only paying 6% interest in cash, but the actual reported number that gets put on the income statement is 13.42%. The difference between 6% and 13.42%, that amortization is a non-cash expense, but it does affect the income statement, and therefore it does affect the earnings per share at the bottom of the income statement. That is just accounting rules. Not much AMC can do about it. But when we add up the amortization of the various debt components, you can see here that with the term loan and the PIK toggle combined, when we put interest expense on the income statement, the net of everything on the old debt was $55 million for these two components. Remember, there are other components of the debt besides the term loan and the PIK toggle. $55 million on the old debt and around $74 million with the new debt deal and the amortized cost of those debt discounts added in. There again, we have about a $20 million difference. I showed you at the beginning of the slide deck how that higher interest rate on the term loan was a $20 million difference. And I also showed you how the PIK toggle, even though it's a lower interest rate, is effectively the same. And on the last slide, we still end up with a $20 million difference when we add in that amortization. I wanted to go one step further, and I'll leave this up on the screen for you to look at. Again, this is somewhat simplified, but to give you even more numbers to dig through and try and find anything that I got incorrect. Knock yourselves out. If you find something, let me know. Again, simplified version. But at the bottom in green is what AMC reported of interest expense for last quarter, $109.6 million. And I wanted to see, could I compute out the interest rate and factor in those discount amortizations and come up with my own math to find a number to match? And I got to $109.2 million there on the far right-hand side of the column. So I think that's within a high enough degree of accuracy to feel confident that my work here is correct. And it is also going to give me the confidence to say that unless the Fed reduces rates or SOFR goes down, you're not going to see a reduction in interest expense in any future quarters until maybe, a year or two down the road when AMC gets a better credit rating, if they get a better credit rating by getting profitable and getting some positive free cash flow. Perhaps they can do a new debt deal, another one, and get a better interest rate by virtue of being awarded a higher credit rating from the credit rating agencies. That's still a year or two down the road. We'll cross that bridge when we come to it. And we got to get to that bridge in the first place. It's still a long road to get there. And we will get some updated numbers from AMC about how Q4 looked here in about a month, probably early March. And then we have to pay very close attention to the box office in Q1 and the free cash flow or cash burn in Q1. So I don't want to misdirect you by saying just focus on 2026. I think right now it's very important that you focus on what is happening in Q1. And also, as we've discussed in many of the previous videos, what is the company going to do about being out of shares, only having 1 million left if they need to ever raise any more money. And I still am noticing that nobody is willing to address that except us here on this channel. And I don't think that you should ignore that. And I do think that the company will do something about that this year. What they do about it, I don't know, but it is one of the short-term risks that has me out of the play for the moment until I find out what they intend to do. At any rate, if you made it all the way through to the end of this video, hopefully this was helpful to you in understanding why the interest expense went up $20 million. And my expectation is that we will continue to see a higher interest expense on the income statements. If you have any questions or you found anything really incorrect in all of the math shown here, please don't hesitate to drop me a comment or reach out to me on Twitter. Send me a DM. Always happy to have a conversation with you guys, and I don't always get stuff correct, but I feel pretty good about the level of information presented here. And if I got it completely wrong, then let me know and I'll delete the video and issue a update. But I don't think that we're going to hear from anybody that says I am incorrect. The challenge is out there. Thank you for watching. I'm Tony Denaro, and I will see you on the next video.